It doesn't affect Social Security or Medicare. Lots of other things will, maybe, but not reverse mortgages. Medicaid can be affected. And I'll talk about that in a second. And you can use a reverse mortgage for a purchase. So I want you guys are going to all walk out of here with a really cool tool in your mind, okay? You can figure out how much somebody can get on a reverse mortgage without a calculator. Maybe you need a calculator, but you can figure it out yourself without asking me. So you take the person's age, subtract 10 from it, and that's about the loan to value ratio they're going to get, okay? So if you have an 80-year-old couple, subtract 10, that's 70%. So they'd be able to borrow 70% of the value of their home. So if they have a $100,000 home, they get a $70,000 loan. Does that make sense? So you guys can all figure that out. If you're with your customers and they're asking about reverse mortgages or that comes up in some way, you could ask them, how old are you? How much do you think your home's worth? You can tell them about how much they can get. So it's a cool tool to have up here. But you can use a reverse mortgage for a purchase. So that same tool, rule of thumb, can be used for a purchase. So if they want to buy a house that's $100,000 and they're 80 years old, how much money do they need down? 30%. Good. A few people listening. So so 30% down. The rest is a $70,000 reverse mortgage, and then they don't have to make any payments. So it's a good tool if people want to downsize from the home that they have. We may see a lot of people in a lot of you here in home care and hospice and stuff. You see people with these great big homes. You know, they could benefit from moving, scaling down, getting a condo or something, and they don't have to use all the money that they get from selling their house to buy the condo. They can just use a portion of it and save the rest to live on. Cool stuff.
Question.
Yes.
I thought that you had to live in the house, though. Didn't you say that?
You do.
But if you buy a condo, to move into the condo?
The reverse mortgage would be on the condo.
Oh, okay.
Right. You have to live there. So Medicaid is, we all know what Medicaid is, right? It pays for, among other things, it pays for nursing homes for people that can't afford care, that need nursing home care, and they don't have anybody to live with, and they need care. So Medicare handles that. People need, what do you have to do to qualify for Medicare? I mean Medicaid.
Yeah.
Sorry. Yep. You have to be broke, right? You can only have a couple grand in your bank account. Otherwise, you got to spend that money on the nursing home till it's gone. Then they'll pay. Then you can apply. So Medicaid is something that is important to keep in mind. Important to make sure that you can qualify for it when you need it. If you have a bunch of money in your bank account from a reverse mortgage, and you can't account for where that went, Medicaid looks back 5 years into your financial history. They have a 5-year look-back period to make sure you didn't hide any money, to make sure you didn't give it to your kids. Here, take this $100 grand. I want to get Medicaid covered, and I don't want to have to pay for it. So they look back at that. So if they have a big withdrawal from their account, that they can't explain, then they could possibly be disqualified for Medicaid, and they may really, really need Medicaid. So I'm very strong with my borrowers to make sure that they don't let their kids get this money. That if they give it all out to their kids, they may not qualify for Medicaid unless they can really document it. So it's a good way to keep the hounds at bay, the children with business ideas. So there's other ways they can use the money. I'm not going to cover that today. But give you some case studies just so you get a feel for how this kind of works. So we've got Jeannie Taylor, 79 years old, survived 2 husbands. Her home is worth $250,000. She has a $92,000 mortgage. This is an actual case of mine. She was paying $725 a month on the mortgage. We were able to give her a $178,000 loan, and so after paying off the mortgage, she had $80,000 cash in hand. They could either take that as a lump sum, or they can do it as a line of credit. Maybe she doesn't need $80,000 today. She can take it as a line of credit. Benefit of a line of credit is that there's no interest accruing on money you didn't borrow yet. So there's no sense in taking $80,000 if you don't need it right now. Get a line of credit, use it as you need it, then the interest is going to build up a lot slower. Okay? Lynette and Verda, best friends, own a home together, $125,000 house. They were able to get a line of credit. Closing costs, $7,000. This is for the line of credit. Closing costs on lines of credit are a little more than on the fix. But the majority of what the closing costs are is mortgage insurance. FHA is the only game in town for reverse mortgages. There are no private reverse mortgages. FHA charges mortgage insurance, an upfront amount and a monthly amount, to be able to do this program. Because what happens when someone lives really long and they owe far more than their house is worth? Who eats that? The lender? No. FHA eats that. They insure the lenders in case that happens. So if the lender forecloses on the house that's way underwater, they're going to file a claim with FHA to get that money. And FHA will pay it. And the way they can pay it is by charging mortgage insurance. That's why closing costs on reverse mortgages are a little higher than a regular mortgage. All the other costs are the same, but you just have additional mortgage insurance on there.
Does the FHA also secure those lines of credit in case that particular financial institution
They sure do.
goes under?
Yeah, you sign 2 deeds of trust and 2 notes. One of them's for HUD, FHA, and the other's with the lender. So if the lender goes bankrupt and can't fund the line, then the Secretary of Housing takes it over. So Verda, they just wanted to split this money up. So they got a line of credit for $85,000, and they just kind of split it together. Here's one about a purchase. They sold their Glenn and Glenda sold their home for $420,000. They bought a smaller home for $260,000. They could have just put $260,000 down and just been out $260,000, but they decided to put $87,000 down and the rest on a reverse mortgage. So now instead of their bank account being $160,000, they've got $332,000 in their bank account because they did a reverse mortgage instead of just paying cash for their house, all of it. Does that make sense? Yeah. So that's reverse mortgages. I hope that's answered all of your questions, but I want to open it up now.